This LOS is analyze the effect of financial leverage on a company's net income and return on equity. Leverage. Leverage increases the volatility of a company's earnings and cash flows and increases the risk of lending to or owning a company. Additionally, the valuation of a company and its equity is affected by the degree of leverage. The greater a company's leverage, the greater its risk, and hence, the greater the discount rate that should be applied in its valuation. Further, highly leveraged or levered companies have a greater chance of incurring significant losses during downturns, thus accelerating conditions that lead to financial distress and bankruptcy. Companies that have more fixed costs relative to variable costs in their cost structures have greater variation in net income as revenues fluctuate and hence more risk. You will recall that we looked at an earlier LOS, the example in the text, which I've got the screenshot now, of Impulse Robotics net income and Malvy Aerospace net income. At 100,000 units, they had the same net income, but Impulse Robotics had the higher fixed cost, the higher financial leverage, so as the number of units increased, their net income increased more than Malvy. But as the number of units decreased, they were the same at 100,000 units, as the number of units decreased, they had greater losses. The net income was much less. So continuing now with our operating risk, financial risk, and total leverage, using financial leverage generally increases the variability of return on income, which is net income divided by the average shareholder's equity. And as we learned before in the accounting section, and I always say, as goes the net income, so goes the R ratios. So ROA or ROE. If net income is higher, you're going to have a higher ROA, ROE. So, of course, we just saw in the previous slide that more leverage is giving us more variability in terms of our net income. It goes to stand that you're going to have increases the variability on the return on the equity, okay? So in addition, leverage, its use by a profitable company may increase the level of return on equity. And we've seen that in the DuPont before, which we've seen the next slide. Assets over equity is the leverage, and that's a multiplier, and it increases the ROE. But let's look at that at the next slide. So recall the DuPont analysis, the decomposition of return on equity. Return on equity is net income over equity, and we could split that out so that the formula, the expanded formula for DuPont is net income over sales times sales over assets times assets over equity. And then just with our little bit of algebra, we cross out the numerator and denominators, and we're back to the net income over equity, okay? So then when you expanded it, just a quick reminder, net income over sales is our net profit margin. That's going to be in terms of percentage. Revenue over assets is an asset turnover, so that's going to be in times. And our assets over equity is leverage. That's also going to be in terms of times. So remember, total assets over equity, we call that leverage. We're looking at leverage here, degree of operating leverage. But also we're looking at assets over equity as leverage. So as we increase the leverage, we increase the multiplier, and we're going to boost the ROE. So we saw that before in the DuPont, and we're seeing it again. And that's the last slide for this LOS. Thank you.